Hello everyone, welcome to the 135th episode of me learning how to trade in Forex. So in the last episode we went through buying and selling. Yes we did. So saying goes, it takes two sides to make a market. The two sides concerned are buyers who usually believe an asset is likely to rise, or asset's value is likely to rise, also known as bulls. Sellers who generally think the asset's values are set to fail or fall, also known as bears. So the relationship between the powers, the movements in the market prices. Let's look at how that works. So basically supply and demand. If there's more demand than supply, then the price would rise. If there's equal supply and demand, then the price is stable. But if there's more supply than demand, then the price would fall. And then we went through the questions. So whether the price would fall or rise. The bid-ask prices, basically bid price is the price you'll receive as a seller, the ask price is the price you'll pay as a buyer. So in the quote, the lower figure shown is normally the bid price and the higher is the ask price. Did the quiz here. Spread, basically the difference between the bid and the ask price. The bid price is the highest price at which a buyer is prepared to buy, the ask price is the lowest price at which a seller is willing to sell. The difference between these two prices is known as a spread, also known as a bid-ask spread or bid-offer spread, and the spread may also incorporate a broker's fee for handling the trade. Then read through lesson summary, and now we're on to what spreads mean for traders. So, what spreads mean for traders. Date is the 14th. Let's get started then. What spreads mean for traders? As a trader, you'll be looking to buy or sell at the narrowest possible spread. In other words, when the bid and ask prices are close together. Let's look at why. As a trader, you'll be looking to buy or sell at the narrowest possible spread. So when the bid and ask prices are close together. Let's look at why. So you buy at ask and you sell at bids. So buy here, the price rises, and we sold here. 2 points of profit. Imagine you buy the asset shown in this diagram as an ask price of 1.2873. If you were to sell again instantly, you only do so at 1.2872. This means you need the market to rise by 1 point the size of the spread just to break even on the trade. If the bid price overtakes the price at which you bought, you are on the road to profit. In this example, the bid price rises from 1.2872 to 1.2875, 3 points. So your gain is based on a 2-point movement. The tighter the bid-ask spread, the quicker you can profit if the market moves in your favour. There we go. The tighter the bid-ask spread, the quicker you can profit if the market moves in your favour. What affects the spread? An asset's liquidity, or the ease with which it can be traded in the market, is the key factor that determines the spreads. An asset's liquidity the ease it can be traded in the market is the key factor which determines the spread. In general, the higher the current volume of trades on an asset, the narrower the spread tends to be. In general, the higher the current volume of trades on an asset, the narrower the spread tends to be. The reason is that if more traders want to buy and sell, more bids and asks are posted, increasing the likelihood that the lowest selling price and the highest buying price will converge. Of course, the spread is also affected by the size of any dealing fees it includes. Fees generally rise when the market is illiquid to compensate the market maker in case they can't immediately find a party to take on the other side of the trades. That's another reason why liquid markets mean smaller spreads. When the market is illiquid, to compensate the market maker in case they can't find a party to take the other side of your trade. That's another reason. Right. On which of these would you expect to see the tightest spreads? A major currency pair, a little known stock. A major currency pair, of course. Forex is considered to be the world's most liquid market, so spreads on major pairs are generally very tight. However, trading volume and frequency are likely to be very low on the stock in this example, leading to wide spreads. True. Prices in over-the-counter markets. Lastly, it's worth noting that in over-the-counter markets such as Forex, where you don't have to deal through a centralized exchange, an array of different bid/ask prices are usually available for a given asset at any particular time. You may have already noticed this when buying currency for foreign travel. Different rates appear on the boards in various foreign exchange bureaux. So if you wanted to trade GBP USD, for example, you could shop around the different Forex dealers to find the best quote for the pair. This is in contrast to trading an asset like an exchange-listed share, which is available at a uniform value, the only cost difference being in the various stockbrokers' own fees. Competition between various over-the-counter dealers also help keep prices keen and benefits traders. In over-the-counter market like Forex, since there isn't a central exchange, an array of different bid-ask prices are usually available for a given asset at any particular time. Cool. Lesson summary. A tighter spread makes it easier for you to profit if the market moves in your favor. The spread is affected by an asset's liquidity and also by the size of any dealing fees. In over-the-counter markets, a range of prices are available and you can shop around for the best deal. Cool. Going long and short. Most people think about trading in just one direction. They imagine buying assets going long before the price begins to rise. Then they imagine selling it just as it reaches its peak to reap a profit. While this is an buy low, sell high, while this is an excellent goal for any trader to aim for, it is by no means the only potential way to capitalize on market movements. Opportunities can also arise in markets that are heading for a downturn, and in this section we'll see how you can trade these by going short or short selling. What is short selling? When you go long, you open your trade by buying an asset whose value you expect to rise and close it by selling, hopefully for a higher price. To go short, you do the opposite. You sell to open a short trade and buy to close it. So if you believe an asset's price is set to fall, you decide to sell it now in the hope of later buying it back at a lower price to make a profit. Yep. So, when going long, you decide to buy now at a low price, hoping it will rise higher in the future so you can sell it off for a higher price, which makes a profit. When going short, you decide to sell now at a high price, hoping it will fall lower in the future so you can buy it back for lower price, which makes a profit. If you believe an asset's price is set to fall, you decide to sell it now in hope of later buying it back at a lower price to make a profit. Yep. This is good. Boom, boom, and then boom, boom. Where do I put this? Boom, 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 boom. Let's make that 26. Of course, you may logically assume that you first need to own the asset concerned in order to sell it, but in fact this isn't the case. It's possible to effectively borrow the asset, you can sell it short.
Buy low, sell high. Conventional wisdom says the only way to trade is to go long. But short selling, going short or shorting, is a way to trade if you think a market will fall. The aim, sell high and buy low. But how can you sell something you don't actually own? Well, let's take Rio Tinto. Imagine it's trading at £34 per share. You think the price will drop, so you short sell 100 shares at a value of £3,400. To do this, you effectively borrow them from your broker. If the share price does fall to, say, £32, you can buy back all 100 shares for £3,200 and return them to your broker. The difference, £200, your profit, less any fees or commission. But if the price had risen to £36, for example, buying back your shares would cost you £3,600, and that would mean a loss of £200 plus costs. Remember, you always need to buy the shares back at some point as they still belong to your lender. Trading derivatives like spread bets or CFDs makes the process of short selling as straightforward as possible. You never own the underlying asset anyway, so short selling is no more complicated than going long. So why do traders short sell? The obvious reason: you can trade a market when it's going down, so bad news and price dips can become opportunities. Another, hedging, where you open a position that can counter adverse moves in your portfolio, offsetting your risk. For example, if you have long positions on several Nikkei 225 companies, you could use a CFD to short sell the Nikkei index as a whole, which could reduce the impact on your bottom line if your Japanese shares start dropping in value. So, short selling has its advantages, but there are potential downsides too. Unlike going long, there's no limit on how much you stand to lose. If you buy an asset thinking it will increase in price, the absolute worst case is it drops to zero. But when you go short, the price could rise indefinitely. This makes it important to use stops to limit your losses. So the risks are there, but if you approach with care, the opportunities provided by short selling really can add another dimension to your trading.
Okay, cool. So, how does short selling work? The easiest way to explain this is through an example. Let's say that shares in XYZ PLC are trading at 1000. Is that 1000p? 1000p. Jonathan decides to borrow 100 XYZ PLC shares from his stockbroker to short sell, as he believes the price will soon fall. Jonathan brokers lend him in the shares, borrowing them from his own inventory, another client's holdings, or perhaps another brokerage. It sells the shares for Jonathan and credits his account with the proceeds, £1,000. The XYZ PLC share price then falls to 800 pence and Jonathan decides to close or cover his trade. The broker therefore buys 100 shares for him, deducting the purchase cost of £800 from his account and returning the shares to their original owner. This leaves Jonathan with a gross profit of £200 in his account. His broker will also charge commission for handling transaction. The lender will require a borrowing fee. And there could be another cost for the trade which we'll discuss shortly. Gross profit £200. Jonathan request to stop lender broker's inventory. 1, 2 broker shares sold short, market shares bought back, broker shares returns, profit or loss to Jonathan. Question: in the same scenario, how would Jonathan fare if XYZ's share price rose to 1,200 pence rather than falling to 800 pence after he opened his short trades? Definitely not break even. Loss. Jonathan buys his shares back for £1,200 and make a gross loss of £200. We can see clearly how going short differs from going long. If the stock does well, Jonathan makes a loss rather than a profit. What are the limitations? In Jonathan's trades above, he was able to borrow the shares he needed through his broker. But what if his broker didn't hold any XYZ PLC shares and nobody wanted to lend the stock? If XYZ PLC was unborrowable at that time, Jonathan would have been unable to make his short trades. Similarly, a lender might occasionally need to ask for its stock back while a short trade is in progress. This is known as being called away. If it happens to you, even if you're not ready to close your trade yet, you may be obliged to cover. It is also worth being aware that brokers may sometimes be unable to offer short trading facilities, for example for assets below a certain value. It's up to each brokerage to set its own criteria, so a different firm may be able to help you if this happens. What if you make a loss on that then? Would the broker cover that loss for you, or would you just have to eat the loss basically? Because the broker forced you to close the trades. So technically it's not your fault, right? That makes sense. So being called away. When a lender needs to ask for its stock back while a short trade is in progress. Question: when selling an asset you don't own, there are certain consequences to be aware of. For example, suppose you borrow shares in ABC PLC to sell short and the company then declares a dividend. The lender who provides your ABC PLC shares, Rebecca, is due to receive this dividend, but so too is a buyer to whom you've sold the borrowed shares. George, strangely at this point, the shares effectively have two owners simultaneously. ABC PLC will pay the dividend to George, who is now the official listed owner of the shares, so who must pay Rebecca? You, maybe? Yeah, you are responsible for paying dividends to the person or firm who lends you their shares. Any other corporate actions will also need to be priced in while you're shorting shares. Clearly, payments like this can reduce any profit or increase any loss that you make on the trades. Oof. Lesson summary. Trading by buying an asset is called going long, while selling is going short. To open a short trade, you sell an asset whose value you expect to decline. To close, you buy it back, also known as covering. If you can now buy the asset at a lower price, you pocket the difference. If an asset's value increases, short sellers will lose money while traders with long positions profit. In order to sell an asset you don't own, you must first be able to borrow it from a lender. You can't be called away from a short trade if the lender needs to reclaim the asset you've borrowed. You can be called away from a short trade if the lender needs to reclaim the asset you've borrowed. If you borrowed shares to sell short, you will need to compensate the lender for any dividends or other corporate actions announced during the borrowing periods. So if you borrow shares to sell short, you'll need to compensate the lender for any dividends or other corporate actions announced during the borrowing period. Cool. Why do traders go short? There are a number of reasons for short selling. Speculation. If you open a speculative short position, your intention would be to profit from a potential downturn in the market. Speculative short selling enables traders to stay active even in bearish markets. However, trading this way does mean assuming a high level of risk. Your loss is theoretically unlimited. Your loss for going short could be unlimited if a stop loss isn't used. Your loss is theoretically unlimited. Yep. Suppose you sell 100 shares short at a price of 1,000 pence. Your maximum profit is 1,000 if the stock sinks to 0. However, if the price rises to say 4,000 pence, your loss is a painful £3,000 and could keep increasing indefinitely if the stock keeps going up. There's no limit to how high the price might go after all. So it's important to manage your risk when short selling. We explain how to do this in the planning and risk management course. Did you know speculative short traders can be beneficial to the market, increasing trading volumes and liquidity? However, they can also influence market movements, even contributing to market crashes. In 1992, George Soros speculated that sterling would fall after a prolonged period in which the British government artificially propped up its value. Weakened by short-selling pressure, including large trades by Soros, the government's policy became unsustainable. Britain withdrew from the European exchange rate mechanism, causing the pound to plummet. By risking 10 billion in short positions, Soros made 1 billion overnight, and his eventual profit was nearly 2 billion. Damn. By risking 10 billion in short positions, Soros made 1 billion overnight, and his eventual profit was nearly 2 billion. Damn. Hedging. While speculators take on risk, in contrast, hedgers seek to protect themselves against it. So, reasons for shorting. Speculation. You intend to profit from a downturn in the market. Hedging. While speculators take on risk, in contrast, hedgers seek to protect themselves against it. Taking a short position is a common strategy to offset or hedge the risk of adverse price movements in a long position you hold. Taking a short position is a common strategy to offset the risk of adverse price movements in a long position you hold. In brief, the idea is that if your long position makes a loss, your short position will make a profit to compensate. For example, if you own a selection of stocks from the FTSE 100, you may take a short position on the FTSE index as a whole to offset the potential losses should the market fall. You'll still see a drop in your share portfolio, but your short position on the index itself will help reduce the overall loss. So a hedge is like a form of insurance, and like any insurance, it has a cost. If your long-term position makes a profit, the short hedge will normally make a loss that reduces it. However, traders often feel the protection offered by the hedge makes this worthwhile. Ways to short sell. In practice, retail traders may have difficulty finding a broker who offers short trading services to private investors. However, you can also go short using a number of derivative products. Options, futures, spread betting, UK only, and CFD trading. Lesson summary. Traders may go short in order to speculate on market movements, taking on risk, or to hedge long positions, protecting against risk. Risk is theoretically unlimited when you go short, and as well as dealing with through a broker, you can also use derivative products to go short. You can also use derivative products to go short. Nice, the quiz. So, yeah, okay. Question 1 of 10. Shares of HIJ PLC are trading at 1,000 pence. You borrow 50 shares of HIJ PLC from your stockbroker and short sell, and are credited with £500 as a result. After opening your short trade, the price of HIJ PLC falls to 700 pence, at which point you decide to cover your position. Ignoring any charges or commission, how much profit or loss would you have made in this scenario? Definitely made a profit, so let me just get the calculator out. So it's just, what's the price difference? 1,000 pence minus 700 pence. 300 times how many shares? 50 shares. Oh no, wait. So 300 pence difference times by 50 shares. 15,000 pence. That equals £150. So £150 profit. If company OPQ reports an annual profit of £163 million, but most analysts are expecting a figure of at least 200 million, how would you expect levels of supply and demand to affect the price of shares? Share price falls because the shares is going to be less attractive to investors because the profit isn't as expected to be. Therefore, if investors aren't really attracted to it, then there's going to be less demand for the shares. However, there's still going to be the same supply of shares, so if there's the same supply but less demand, then the price is going to fall. As a trader, why might a tight spread be advantageous? The tighter the spread, the quicker you can profit, the market moves in your favour. Yep, that's that. If you sell 500 shares short at 4,000 pence, what is the maximum amount of money you could lose ignoring any charges or commissions? Unlimited. If a broker provides recommendations on investment opportunities but leaves the final decisions up to their clients, what kind of service are they offering? Advisory management. Because full service is the one where it does everything for you, it manages the portfolio for you. Execution only is the one where you have to tell them what you want to do. So, advisory management. Sellers in the market commonly referred to as which animal? Sellers, bears. If you sell 100 shares shorts at 3,000 pence, what is the maximum amount of profit you can make, ignoring any charges or commissions? So, the maximum profit you'd make is when it drops to zero, when the shares drop to zero. So if the shares drop to zero, then that would just be 3,000 minus 0, which is just 3,000, sorry, times by 100, 300,000, which is 30,000 pounds. Let me take 2 zeros away. No, it's 3,000. Divided by 100, yeah, 3,000 pounds. If you decide to buy GBP USD and your broker quotes a bid price of 1.54296 and an ask price of 1.54304, at which price will you open your trades? if you want to buy, so this is the 1.54304. Which of the following markets are traded on exchange? Shares, not that. Gold futures, property and real estate, I think that. Which of the following can be considered as institutional investors? Banks, mutual funds, all of the above. 90%, which one was wrong? You made £500 from opening the trade, then spent 700 pence times by 50, or 35,000 pence, or £350 to cover your position, meaning your profit was £150. Yep. Despite company ABC posting a healthy profit, it wasn't as large as the market was expecting. As the company isn't doing as well as predicted, this is likely to make the shares less attractive to investors, triggering a sell-off. The resulting increase in supply of shares on the market will cause the price to slump. As a trader, why might tight spread be advantageous? Well, with wider spreads, you need the market to move in your favour to a more significant degree to just break even on your trades. When you sell short, your losses could technically be unlimited, as the share price could keep rising forever. A full-service broker will actively manage a client's investments and provide personal advice, while an execution-only broker will simply carry out a client's instruction to trade on demand. When prices are falling, the downward movement of the market resembles a bear swiping down to attack his opponent. Oh, is that where bear comes from? Right, a bear swiping down to attack his opponent. Ah, interesting. If the stock size sinks to zero, you would make 100 times 3,000 pence, which is £3,000. You always buy at the ask higher price and sell at a lower price. Which of the following markets? Currencies and properties are traded between individual participants without the need for a central exchange. Ah, right, okay. Right, okay, yeah. Institutional investors are organisations that deal in the financial markets, generally on a much larger scale than retail traders. Pension funds and life assurance companies are other examples of institutional investors. Very good. The second course done, how does trading work? Third, orders, execution, and leverage. Orders, execution, and leverage. In this course, we'll guide you through the process of actually placing a trade, touching on some key trading concepts along the way. We'll show you how to choose the right types of orders for your needs and how to take steps to protect yourself in case the market turns against you. And we'll also examine the commonly misunderstood concept of leverage. Find out why, used wisely, it can help your trading, but can also result in large losses if you don't control your risk. Let's go. What is an order? An order, so date is the 14th. Do that, boom, 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 here, let's go. What is an order? Suppose you decide you're ready to open or close a trade. How do you do it? You'll need to give your broker or trading provider the details so they can buy or sell on your behalf. This is called placing an order. What is an order? An order is simply an instruction to buy or sell an asset. Simply an instruction to buy or sell an asset. There are various types of order, enabling you to either trade immediately or to wait until certain market conditions occur. Once you've placed an order, you're free to turn your attention away from the trading and leave the order to get on with the job in your absence. Depending on the type of order you choose, it can automatically open a trade at the time when you judge the conditions are just right, lock in profits by closing a trade when your target level is reached, limit losses by closing a trade when the price moves against you by a certain amount. Depending on the order type, it can automatically open a trade at the time when you judge the market conditions are just right. Lock in profits by closing a trade when your target level is reached. Limit losses by closing a trade when the price moves against you by a certain amount. Limit losses by closing a trade when the price moves against you by a certain amount. You'll see how to choose the right order to do each of these things as we go through the different orders or different order types in the details below. So, market orders. If you simply want to deal immediately at the best price available, a market order is the one to use. If you simply want to deal with the deal immediately at the best price available, if you simply want to deal immediately at the best price available, provided the market is liquid enough. In other words, if there were enough willing buyers and sellers around the time, your market order will be executed immediately. An order that's been executed is called a filled order. An order that has been executed is called a filled order. It's important to be aware that market orders can be filled at a worse price than the current bid-ask price. We'll explain how this happens later in this course. However, market orders can be filled at a worse price than the current bid-ask price. I'm assuming that's going to be like slippage or something. Current bid-ask price. Limit orders. On occasions when you want to wait until a price reaches a more favourable level before you trade, you'll need to use a limit order. When you want to wait until a price has moved, the price has reached a more favourable level before you trade, you use a limit order. A limit order is an instruction to trade if the market price reaches a particular level that's more favourable than the current price. When you want to wait until a price has reached the more favourable level before you trade. When the price... Example, let's say GBP USD is currently trading at 1.5055. Your analysis suggests that if it rises to 1.5065, it's then likely to fall again. So you decide to sell GBP USD if it reaches 1.5065. Rather than sitting in front of your screen monitoring the market, you place a limit order, known as a limit entry order, to open a short trade if the price hits 1.5065. 2 hours later, the market does indeed hit this level. Your broker executes your order and you sell GBP USD. Your trade then works in a normal way. So if GBP USD falls as you predicted, you make a profit. If it continues to rise, however, you make a loss. As well as using a limit order to open a new trade, it can also be used to close an existing position, protecting your profit if you're concerned the market might change direction and wipe out your gains. Question: Imagine you're buying shares in XYZ PLC currently trading at 300 pence. Later you see the price has risen to 310 pence. You're not tempted to sell yet as you think the market will keep going up. However, you believe it's likely the upward trend could reverse if the price goes above 320 pence. So you set a limit order to close your trade if XYZ PLC reaches 320 pence. Later the price rises to 325 pence and then starts declining again. What happens to your trades? Your limit order is triggered and your trade is closed at 320 pence. There we go. It's that one. Your limit triggers as the price passes through the level you specified. In this case, 320 pence. If the price subsequently falls, you won't lose your profits. However, this also means you can't take advantage of any other movement in your favor. Any further movement in your favor. Lesson summary. An order is an instruction to buy or sell an asset. A market order will be executed immediately at the best price available, provided there is sufficient liquidity. Provided that there is enough liquidity. A market order may be filled at a worse price than the current bid-ask price. A limit order is an instruction to trade if the market price reaches a particular level more favorable than the current price, and you can use a limit entry order to open new positions or attach a limit order to close an existing position when the price hits your target level. Or add it to an existing trade to close it when the price hits your target level. In the next video we're going to go through using stop orders. So thank you for watching, and I will see you guys in the next video. Bye bye.